This is Bazaar Morning Call, broadcasting live from the CNBC TV 18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. It's a Thursday morning. We are, as always, coming to you from the CNBC TV 18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Sonia and Nigel. Guys, hi, good morning.
Hi, morning.
Hey, good morning. Holding on to that 19,400 mark yesterday. And once again, it's a kind of like a repeat of what was happening yesterday, right? Fall in crude prices. All eyes will, of course, be on Jerome Powell's comments. So lots to track today.
Yeah, and then the festive season is picking up, right? Less traffic on the road. The kids are at home. They're lucky. What about us?
You think the traffic is less? I was just thinking about it. Towards the weekends, as the festive season picks up, the traffic is
No, I'm saying on weekdays though, Sonia.
On weekdays,
yeah. Schools are shut. You know, you have those couple of bottlenecks when you're coming to work that going to get stuck out here. Really none of that. So that's good.
Well, clear in the morning at least, right?
Yeah.
Things market-wise are going to be clearer, or are they going to be a little confusing? I would say it's a second rather than the first. And I'll tell you why. So let's just quickly begin with the big things that happened overnight. So, U.S. yields and oil, they continued to sell off. So that's point number one. Last night was a repetition of a lot of what was happening over the last few trading sessions. So there is everything happened in the same direction, but the intensity of it was lesser. And you'll see why. So yields fell for the sixth time in 7 days. Yields fell. The 10-year, for example, fell about 5 basis points to 4.1%. By the way, the entire curve, which is starting with a 2, 5, 10, 30, the entire yield curve is getting flatter, which means the difference between, where the 5-year is and the 30-year is, or the 10-year is and the 30-year is, the difference is shrinking. So it's getting a flatter kind of a yield curve. Lots of debate about what that could really mean. Because it should not be flatter, but that's what's happening right now. Oil prices, they sold off once again. As I said, repeat, but lower intent. The day before yesterday, we had a 4% fall. Last night, we had a 2% fall. And now we are below $80 a barrel. It's now kind of gone to the 200-day moving average. So a lot of technical stuff happening. But fundamentally also, for example, earlier this week, we had the IEA, which lowered their oil price forecasts for the year. Ahead. So there is some stuff happening there as well. But prices have come off very sharply. Almost, $20 or so, more or less, in the last 1 month. NASDAQ, well, that made it to its ninth straight day of gains. So again, repetition, but very marginal, right? Actually absolutely flat, or eked out a small gain. And the small cap index in the US, which is much more representative of the broader economy, the Russell 2000, that underperformed once again, and the underperformance there was about 1.17% or so. So that's the global backdrop. I would say it's an okay backdrop in the sense that, yields are lower and oil is lower, but it is also, you've got to wonder whether it is also sending you a bit of a risk-off kind of a signal. The pace of the fall, you want yields lower, you want oil lower. But the question which one is left wondering with is whether these are signals of maybe sharply slower growth or something else. So, and that is not what you want. So we'll see. Coming just to the market here, and I want to start with not the Nifty, the Bank Nifty. The small cap index yesterday made a new all-time high, right? But if you look at the broader market volume, there was no real substantial expansion in market volumes, which to my mind, is not exactly a great thing. It's not a positive thing. You want the market to go up with volumes, which was not the case, at least in terms of incremental expansion in volumes. The Nifty itself, it ended slightly above the 20-day moving average, which actually is now at about 19,393. We ended at about 19,443. So we are above it, and that kind of becomes something you need to defend now on the way down. Next resistance is about the 19,500 level. These are retracement levels, basically, of the full fall from the all-time high to the lows that we saw the week before last. And post that, you get to around 19,700, 693 levels, which is the 61.8% retracement of the fall from the highs. And supports for the Nifty come in at about 19,300. I think it's possible, just possible, that you basically get a day, 2 days of cool-off. The market maybe tests this support, 19,300, maybe a little lower, and then it makes a bit of a push higher once again. We'll see. But it would not exactly be unhealthy. We've had a sharp move up very quickly from the lows. On the Nifty Bank, we are now above the 20-day moving average. We've kind of built on it. 43,520 is the 20-day. Next resistance levels are based on retracements against the 50 and the 61.8, which are 44,200 and 44,700. And supports for the Nifty Bank would come in at about 43,200 or so. So, I mean, that's again about 1%, a little over 1.25% or so away from where we left off yesterday. GIFT Nifty is indicating a higher start, and we'll pick up when we kind of get that start. 35 points higher at about 19,526. Sonia.
I really like the texture of the market. I'll tell you why. There are many reasons which are supporting the markets to move up from here. Of course, one of them is the festive season, right? There's a general festive cheer. But apart from that as well, if you map the last couple of days, you'll notice that the Nifty has been holding around that 19,400 mark. In fact, global markets have also consolidated after a very, very strong run-up that global markets have had. There is a positive bias across the board. Just look at the flows, right? Domestic institutions have been buying in the cash markets for the last many days. So yesterday as well, 524 crores of buying. But more importantly, the FI selling has dwindled. There was barely 85 crores of selling by the FIIs yesterday, and the number has been lower for the last many days. So that's always a good thing. The mid-caps outperformed yesterday, and that's another space that perhaps you'd want to look at. Just look at the way the mid-caps moved. A 1% rally yesterday while the Nifty was hanging on to the 19,400 mark. So all in all, the cues are on the upside. The fall in crude continues, so that's positive for our own markets. Brent is at a 3-month low below $80 a barrel. And yesterday you did see stocks like Asian Paints rise in trade on the back of the falling crude. So that's another pocket to look at. Investors will watch data from the US. There's the US jobless claims that comes out. There's remarks from the US Fed chairperson Jerome Powell that will be watched closely. But in our own markets, if you're looking out for any stocks, there are plenty to talk about. There's the pharma sector continues to report strong earnings. The latest is Lupin, where the numbers were better than what the street was expecting, and it was an over 30% growth that they saw in their US business. So that could be one of the stocks in focus. Tata Power, United Spirits, a couple of other names that have delivered good numbers this quarter, and Tata Power has been a big stock this year as well. And in terms of earnings to watch, there are lots from the auto space. There's M&M, there is Ashok Leyland today, there's Eicher Motors tomorrow. So we have our hands full. But all in all, I think, this is a market that's aching to move up, just waiting for some of these hurdles to get crossed.
Well, that's right, Sonia. And as long as, the 10-year yield as well as Brent crude prices, they are lower, they're well behaved, right? So that's good news, and that bodes well for the Indian equity markets as well. In terms of, how our markets have done, well, in November so far, actually, the US markets, they're up between 3 to 6%. And the Nifty is up only around 2%. So we'll have to see some bit of catch-up actually from here, because the US markets, it appears, they have done far better in comparison to what we're doing. We are participating in this global up move, basically. The bears, though, they are positioned to protect the 19,500 to 19,550 odd mark. Today's weekly expiry as well, so we'll see how that goes. What did the FIs do yesterday? Well, they added more shorts than longs. So now the short position goes to around 81%. Close to around 4 shorts is what they added for every 1 long position. On the option side, we have 2 strikes that are fairly active and have the highest open interest. 19,500 on the upside, 1.4 crore shares out there. And on the downside, the 19,300 put. Both those 2 strikes should come up for you on the screen. Both of them have open interest in excess of 1 crore shares out there. Now, on the 19,500 call itself, the premium has come down to around 20 rupees from around 40 rupees odd. So it has seen some bit of writing at those levels. Which brings us to the levels. Since we're seeing writing at the 19,500 call, yesterday as well, it was fairly active. It has the highest open interest as well. So the odds are 19,500, 19,550 are defended in the near term. And that's what the bears are positioned for. Though on the downside, 19,250 to 19,300, that was a bit of a resistance zone. Now that becomes a near-term support. And you plug in the technical levels, well, they perfectly fit in this range that we're talking about, 19,250 to 19,550. You have the 20, 50 and 100 DMA, all of them in that vicinity. For the Nifty Bank yesterday, it did give up a little bit. Maybe it was weekly expiry related factor. But those are the key levels you wanted to continue to trade above, the 20 and the 200 DMA. It crossed that, it's trading above that, but you don't want it to breach that level decisively. GIFT Nifty suggests a green start, that's a 30-40 point uptick. You'll want the Nifty to build on this because we open bang in that resistance zone.
All right, Nigel, we'll sort of pick up on that. And so that's a setup that you need to know from a 360-degree point of view. We'll get you some calls now. This is on the money markets coming in. The rupee, Parul Mittal Sinha of Standard Chartered says that The USD INR continued to trade in a tight range last week. Impact of dollar volatility and lower oil prices was offset by probable USD buy-sell activity by PSU banks. She expects the USD INR pair to trade between 83.1 to 83.35 to the dollar next week, with focus on the US CPI as a key driver along with oil prices.
Okay, let's also try and get you some bond market views. Parul says the domestic rates have traded with a downward bias, tracking global rates post the FOMC and a decline in oil prices. She expects the 10-year bond yield to trade in a range of 7.2 to 7.3% next week, with a focus on India and the US CPI data. She also says their research team sees India's CPI at 4.85%.
Well, we have a lot of stock-specific action to track for you. We'll get to that in just a bit in our special Top 10 segment. There'll be a lot of stocks that'll be reacting, but we have selected these in our Top 10 segment. You have Pidilite Industries, Tata Palm, Lupin, Biocon, we have Eris Life, United Spirits, PI Industries, Patanjali Foods, and Ramkrishna Forgings. All of them reacting to positive news flow. On the flip side, BHEL as well as Bata, they'll be reacting to negative news flow.
Okay, well, there's a lot of stock-specific action, which we will get to in just a bit.